Hi, hi. My name is Sidhartha Dash, or Sid Dash, and I'm from Chartis Research. I will today. I'll be joined by Peta, and we'll be discussing the challenges and the issues of industrializing financial advice, the challenges, risks, trade-offs, and the whole sort of ecosystem thereof. So, without further ado, I'd welcome Peta. Please could you introduce yourself, and then we dive in.
Thank you, Sid, and good morning to all of you. My name is Peter Kolm. I'm a professor at the Courant Institute of Mathematical Sciences at New York University. Prior to returning to academia, I worked for Goldman Sachs Asset Management for a number of years, and now in my role as a professor and as a director of a quantitative finance program here at NYU, I have continued to be very active in industry, uh, sitting on a number of advisory boards, most notably boards such as that of Betterment, such as that of ISOT Technologies, the Alternative Data Group, and also GoQuant. And in these roles, a central conversation has been that of financial markets and the difference between retail and institutional investing.
Thank you. And given that background, I can't think of anyone better placed to discuss the challenges of non-institutional investing, if you will. I mean, if you think about financial advice for a broad audience, or if you think about what the kind of advice you can provide non-institutional investors, the process is labor intensive, but it is critical. It is important, and it is a what do you see as the key state of play for standardized and mass market advice in, say, key areas such as robo advisors, financial planning by retail banks, retail brokerages, etc.?
Yeah, as probably the majority of you already know, financial advice come in many different shapes and forms depending on the amount of money that you have accessible. So there is, of course, the ultra net worth individuals. Then there's various levels of wealth management, and then there's financial planners and also robo advisors. So a big part of this is how much money that you have that you can bring and that you can put to work. Also the level of sophistication of your financial wealth comes into play. And traditionally, the majority of firms have been focusing more on the higher end of this market, right? So typically, it used to be above a million or so, and perhaps now more recently, in the last 5 to 10 years, we have seen a wealth advisory being offered by banks for people that maybe have somewhere in the order of about 100K or so. And at the same time, we've seen the emergence of what people often refer to as retail brokerage firms, or more popularly called neo brokerages, where individuals such as you and me can set up an account and we can trade at quote unquote no cost. There's no commissions. In addition to that, we have a number of robo advisors. The the crux of wealth advisory is, of course, services, the costs to provide services. And for individuals that are willing to invest a lot of money, a very small a percentage fee goes a very long way, right? Ultra net worth individuals will often pay north of a percent in fees, and on a large amount that amounts to nice revenues for the wealth management services. Robo advisory services, they are often somewhere in the range of a a quarter point, maybe to 3/4 of a percentage points in terms of their fees. And of course, retail brokerages where there's no commission for the retail investor, at least that gives the appearance that you can invest at no cost whatsoever. So the emergence of these more less expensive kinds of services obviously relies on technology. And I think that I think looking a little bit at the robo-advisors, and I'll talk a little bit about those next, gives an idea of where these things are going. So robo-advisors have been around for a little over 10 years now. I think it's fair to say there were some earlier robo-advisors that came out before that, but it's in the last 10 years or so that robo-advisors has clearly put their foot down and started to emerge. During the early stages of that, people overestimated the growth of this market. The adoption of robo-advisors has been steady, but significantly slower than what is expected. So today we know that roughly 10% or so of the U.S. population is making use of a robo-advisor. That should be compared with roughly about a third of U.S. individuals making use of a financial planner, right? And in turn, that should also be compared to roughly 55 or 60% of U.S. individuals who are directly or indirectly invested in the stock market, typically through their retirement account, and perhaps also holding individual stocks in a brokerage account.
And,
Yeah,
sorry.
go ahead, Sid.
No, go ahead. Sorry.
So one trend that has now emerged, perhaps in the last 5 years or so in this market, is that of AI and machine learning technologies that has enabled robo-advisors to significantly automate this process of providing advice. And this is not just through systematic investment models, such as those that we are perhaps familiar with in the institutional space, but also when it comes to chatbots, Q&A type of engines, recommendation systems. Many robo-advisors provide now a suite of these technology platforms that in some sense serves as an end-to-end platform for investment advice. In addition to that, what we have seen is many of the robo-advisors are now broadening the types of services that they provide, right? It's not just investment advice, but they recognize that people want to have a one-stop shop for all of their financial advice, such as that of banking services, things that pertain to retirement planning, tax optimization, debt management. And what we see are key factors in this space that I think are driving this market, right? Is again, where I kind of started off here, is that there is an increased demand for low-cost investment advice, and that is attracting people to this space. We see predominantly more tech-savvy individuals that are moving into the space. Notably, and I think this is interesting, during COVID, during the, say, 2 years of COVID or so, there was an increased demand for robo-advisory services. And those individuals who started during COVID have stuck to it. So I think that this is definitely a market to continue to grow. By way of numbers here, some numbers I can share with you. I think globally, we're expected to see end of this year about $2.7 trillion in the robo-advisory space. This is worldwide, but a big part of that is in the U.S. End of 2023, we expect to see around $1.2 trillion invested in in robo advisory services. These are numbers I got from Statista. Average AUM per user worldwide is about $8,000, and that should be compared to in the US, where the amount is about twice of that. So in other words, 16,000 in an average account. And there are significant revenues in the space. In the US, expected revenues end of this year is in the order of 50 billion or so.
That's a very impressive move. But how do you see robo advisors tackling themes like things like retail lots versus institutional lots, liquidity issues, etc.? So, I mean, I can see that they provide additional advice beyond what institutional investors have. They've moved on to tax and other elements. But how do they address key challenges such as, from a theoretical perspective, things like lot sizes, liquidity dimensions, which are quite different for these amounts, 8,000, 16,000, sort of AUMs, if you will. Equally, how do they address risk profiling challenges at scale and with all this variance between different retail investors who may be very differently situated in their life, life and evolution, if you will?
Yeah, if we step back a little bit, I think one really important point to keep in mind is that today, financial illiteracy is still relatively high. And I think that financial planners, robo-advisors, and other kinds of advisory services, in their fiduciary responsibility, they need to help individual investors make the right kinds of decisions and teach them about financial planning, so that people understand what it is that they're getting into. It's very easy to kind of get stuck in this, retail versus wholesale, retail versus institutional investing. By no means do I think the right way to think about retail investing is to give retail investors all the tools of institutional investors, without understanding what it is that they're getting into. It's important that people have a better and broader, more holistic view of investing, understand its risks, right? Understanding the kinds of goals that they have, their financial goals, right, at different stages of their life, planning for college, planning for having a family, planning for a house, planning for retirement, and how to go about that. So I'm a big proponent of pushing that educational angle, and I think that these services can do that at the same time as they're offering trading services, right, investing services.
On to the issue of neo brokers, and I mean particularly entities such as Robinhood. They have sort of gamified the whole trading process. How do you see that evolving, and also the issue of, if you provide all the tools, or if you provide all the asset classes, options, etc. I mean, does that make it too complex? Does that provide risk profiles that are somewhat inappropriate for the retail investors, or do you segregate retail investors by either assets or the nature of their risk profile and allow them to invest and use different kinds of tools?
I think it comes down to basic principles. Here, people need to understand, risk versus return and fees, and also what it means. Whether this is a taxable account that they're invested in or a non-taxable account, such as that of a retirement account. Those basic principles, it might be surprising to many of you, that those basic principles are not broadly understood. And if people don't understand those, and can measure or understand the kinds of risks that they are taking, then we're putting them in a very dangerous spot, right? We know from the literature of behavioral finance that individual investors experience a number of behavioral biases, right? Short-sightedness. People have a propensity of liking lottery-like payoffs. These are all signs that shows that individuals don't necessarily understand investing from a rational point of view. Come now the neo brokers, that are providing lucrative offers of you trading for free without commission, fractional shares. And these are developments that I think are good more broadly, but it needs to follow along with education. People need to understand what it is that they're getting into. The investing is not another lottery.
In fact, sort of going down that path, how do you see visualization and sort of visualizing the different risks and the different strategies, etc.? In some ways, it's a two-edged sword. Visualization makes everything easier to understand, but it also removes some of the boring complexities of having presented it as numbers. So how do you see the process of visualizing and providing more tool-based approach to investing? Yeah.
I think that's a really great question, and it's a question that a lot of people in the space are battling with. How do we present information to individual investors that is understandable, that is palatable, and that provides an unbiased view of their portfolios or their financial stance. Financial professionals, like many of us here, we understand the trade-off between risk and return. We can look at efficient frontiers. We talk about risk aversion, things of that nature, which is well beyond the common understanding. I think that goals-based investing, as one example, is a step in the right direction. People do understand when I say to them that the likelihood of you hitting this goal of purchasing this second home is this much, and if you allocate X more towards this goal, that increases your probability with this much. That's a much better way of communicating things. And of course, I can also graphically depict those, provide charts that give people a better insight. One of the challenges, though, in this area is that these graphs and the underlying analytics that goes into computing these numbers, these are not deterministic numbers, right? These are often estimates at best, and we have to think about them with confidence intervals around that. So how do we portray that to individuals? That's a challenge. Do people understand a simple language such as that of the likelihood or the probability of you hitting this goal is 0.7, plus minus 0.1. Do people understand that? Can they conceptualize that and compare that to other goals? I don't think we're there yet. I think we need to put more work into displaying and sharing this kind of information, but we this is a step in the right direction.
No, absolutely. Getting that balancing act between how do you get visuals that allow people to understand, and how are they theoretically accurate, or enable people to understand probability. Probabilistic activity is one of the hardest thing to understand. I would argue that even institutional investors often have a challenge understanding probabilistic elements, explaining that to people whose livelihood is not trading or finance, can be probably even more so. Uh, Sort of going from there, where do you see the sort of the key next steps? What's the roadmap? Where what do you think will happen? What are the big events that will change retail financial advice in the next 2 to 3 years, if you will?
Yeah, I think the intermediate to long-term trend here is that we're going to see a convergence of services, right? We're already on that path in some sense. We're going to see financial advisory services, robo advisors are going to merge with banking services, and are going to merge also with neo brokerage type of services. Individuals don't want to go to 3 or 4, perhaps even 6 different places to monitor and track their financial life. Having a bank account with a bank, having an robo-advisory account, having a financial planner, having perhaps a retail brokerage account. These are way too many accounts for people to oversee. People like simplicity. So I think that is the key trend, a trend here. Now, one of the big questions that many financial planners and robo advisors have is distinguish themselves from each other. It is a competitive space. But how do you stand apart? And it's already clear to us that it's not necessarily about offering the best risk-adjusted return, perhaps also fee-adjusted and after-tax adjusted returns. Often what is more prevailing is providing a whole suite of financial services along with a strong marketing message, right? The emergence of some of these neo-brokers and the popularity of some of these neo-brokers is not because they have a fantastic investment model that they're building on top of. It's often because they're easily accessible, and they come with a very interesting message.
Thank you. That brings this. We'll bring this conversation to an close here. But there's many interesting themes here: accessibility versus theoretical modeling, etc. How do you get appropriate visuals and conceptual models so that people can understand, and would be backed up by correct structures and so on. However, it clearly is that this is a rapidly growing area and will continue to remain an area where we need to think about the theoretical and practical underpinnings of it as it sort of evolves, if you will. Thank you very much, Peter, and look forward to any further discussion on this. Thank you.
Thank you, Sid, and thank you all for listening today.